Welcome to Street Check, the weekly podcast from Cabot Wealth Network, which has been publishing investment research, insights, and recommendations since 1970. I'm Chris Preston, Cabot's Vice President of Content and Chief Analyst of our Cabot Stock of the Week newsletter.
I'm Brad Simmerman. I'm the Web Editor and Chief Analyst of the Cabot Wealth Daily newsletter. And every week on Street Check, we like to start off with our big three. Those are three pressing news items that deserve your attention this week. We're going to look at inflation and what that means for the Fed. We're going to talk safe banking. Is it making a comeback? Is it bullish for cannabis stocks? And then in between those two, we are going to touch base on short selling in bank stocks, something that JPMorgan has been asking for since the regional bank crisis started. And then after we hit our big three, we're going to bring on Bruce Kaser, the Chief Analyst of Cabot Value Investor and Cabot Turnaround Letter. And we're going to talk value investing and Omaha.
Brad, you sound like you didn't get much sleep last night. In fact, no, you didn't. Explain yourself.
Yeah, so the voice is a little bit rough. I took my son to the Suns playoff game last night.
It's Phoenix Suns.
Phoenix Suns.
Brad
NBA
lives in Arizona. Spoiler alert.
NBA playoff. The Phoenix Suns. The less said about that, the better. I will just leave it at this and say, my son learned the phrase, other than that, Mrs. Lincoln, how was the play last night?
Nice. You probably left the game, like 10 hours ago as we're recording? 10, 11 hours ago? Something like that.
Yeah, I got home 10 hours ago.
Nice.
And then had to, make lunches and do stuff like that. But
nice. Well, we'll try and get through this. Fortunately, it's your turn for Defend the Take. As Brad mentioned, every week, one of us, we take turns defending a take about the market that may or may not be controversial. This week, Brad, your take is that the S&P 500 will break below 4,000 before it breaks above 4,200. You have 90 seconds. Go.
All right. So I'm going to need some assistance from producer Madison here. Madison, if you could do me a favor and bring up the weekly chart of the S&P 500. So what we're looking at here
I'll give you an extra 15 seconds. Sorry.
Am I going to get an extra 10 seconds for that intervention?
Yes, I am.
Okay. So the segment's going to be 3 times as long. No. So we're looking at a chart of the S&P 500 going back to the end of 2020. You can see for all of 2021, it's a strong uptrend. It's trading above its 50-day, its 20-day EM or 20-week, EMA. Upper bounds of that trending range is the upper band on these Bollinger Bands, the green lines here.
And this is only for people who are watching on YouTube. You'll just have to people listen only. They'll just have to imagine it, or they can easily pull up a S&P chart themselves. Anyway, go ahead.
If you'd like to see the chart, bring up a weekly chart of the S&P index. If it's on stockcharts.com, weekly, fill the chart, add Bollinger Bands and the 50 and 200 week moving average. Market sells off all through 2022. We know that, don't need to really cover it. But what's happened since then is what Mike has been talking about a lot, which is selling on strength, not a lot of momentum, not a great trend. But what we have here is we actually do have a weak range-bound positive uptrend. Our guest is probably thinking that these are just crayon lines drawn by a child, but I do think that there's some value in technical analysis. But my expectation is that we're going to continue to oscillate within the Bollinger Bands, within this tightening band range, probably around the 20-week exponential moving average, which is at the middle of that. So I think we're going to be looking for support closer to the 200-week or even towards the 50-week is still going to break below 4,000. But I do think that despite how bad the range-bound trading is going to be, we are still trending higher. I do think that even if we break 4,000 before we get above 4,200, that we end the year above 4,200 on the S&P.
Okay, I gave you a little over 2 minutes, but that was only fair since I had a couple interruptions there. So basically, you think we'll end the year above 40. S&P will end the year above 4,200, but there'll be a detour, at least in the next few months before we get there.
Yeah, all the trading right now is driven by individual investors. Most of the most of the institutional investors are sitting on the sidelines, heavily allocated to cash. They're sort of waiting for a catalyst. Mike has been writing about it a bit. So when we've got only retail money moving the market, it tends to be more susceptible to range-bound trade because it's very sentiment-driven and it's very news-driven. So my expectation is that that's going to continue to be the case, at least going through probably the summer, and that makes sub 4,000 a reasonable target in my mind.
Yeah. And yeah, sorry, I failed to introduce our producer, Madison Robertson. Madison, I'm correct in assuming this is your favorite 30 minutes of every week, our podcast. Is that right?
I look forward to this part of my Friday for the entire week.
Yeah, the Friday part of it, I'm sure, is what you really love.
Just like our listeners, Chris.
Yeah,
waits with bated breath to get this 30 minutes every week.
Yeah, Madison will be the avatar for our audience. Just her level of excitement, I'm sure, will be exactly matching the audience's. Okay, so we'll move on to our big three. Topic number one, as Brad mentioned up top, inflation dipped below 5%, barely, 4.9% this week, but symbolically significant. What, Brad, do you think? So my defend the take last week, for those who listened, was I said there'd be no more movement in the federal funds rate this year, period, up or down. I said it would be at, 5.25% for the rest of the year. What do you think it would take for the Fed to change the rates in either direction? Do you think maybe dipping into the 3% range for a cut, or possibly a bump back above 5%? Hopefully that doesn't happen, to raise again. What do you think, or is there a threshold in either direction?
There is. I mean, there always is, right? There's always something that's sort of black swanny that's hanging over our heads. I mean, we would probably need to see like a surprise, unexpected spike in core inflation. Maybe see that the slowdown in lodging inflation. See if that were to be curtailed, and if we saw prices start spiking higher, maybe then the Fed is going to come back in and raise rates. I think that's sort of well outside maybe the realm of possibility. As far as the cuts go, if inflation came in below 3, I mean, that seems like a green light to me. I don't know.
Do you think below 3, not in the 3s?
Yeah. They've been very adamant in every meeting saying 2%, right?
Yeah.
They haven't deviated from that and said, 2.5%. That's actually okay. They've stuck with 2%, even as regional banks were breaking. So I don't think that something in the 3s is going to give them the green light to start cutting rates. Maybe if we have a debt ceiling crisis that crushes the markets, or maybe if there's real pain, we get something. But until that, I don't know that we're going to get a ton of change in stance from the Fed.
Yeah, you're probably right. It feels like, maybe 2.9%. Maybe they would do it anything with a 2. And we're only 2% away from that now, considering we were at 9.1% less than a year ago.
Yeah, as much as we would like to be able to treat this like it's some academic pursuit that's being handled exclusively by like robotic bankers that are just making whatever the best fiscal choices are, these are ultimately human decisions. And politics gets into it, fear on Main Street, legacy for the Fed, credibility for Powell, like all these things factor in. So I don't think that they're going to stick to, hey, until it's below 2%, we will not touch rates. There's a human factor there too.
Yeah, and it may never get there anyway. Okay, you want to introduce our second topic?
Yeah. So interesting note came out last weekend. JPMorgan Analyst called for a ban on the short sale of bank stocks. And it's very intentional. One thing that we have talked about, and I'm not sure if we talked about on the Fed, but I think we probably got into it a little, is when we have these periods of like significant sector weakness, like we have with the regional banks, you tend to get people hunting the next short target, right? So back in 2008, it's like, okay, well, WAMU's gone, we're going to hit Citi. Okay, Citi's gone, we're going to hit Lehman, right? So you're looking for the weak gazelle in the herd. And in 2008, what we saw was a 2-week ban on bank short selling that in retrospect is largely being blamed for worse performance than if they had not banned the short. because what it does is it drags out sort of price discovery for it drags out price discovery, and it creates a period of time when the outlook is more uncertain as opposed to less uncertain. So short sellers couldn't target banks in 08. It essentially creates the impression in the investing public that if there's smoke, there's probably fire. And then you end up having underperformance in the asset classes, or I'm sorry, in the asset class that the shorts have been banned. And as much as it sort of makes sense to try and slow down the weak gazelle and the herd hunters, what it ends up doing is just creating more confusion and uncertainty in the marketplace. And I don't think it's a responsible move. I don't know that Gensler and the SEC are taking it seriously. They've been rigorously investigating firms and public individuals that have been benefiting from shorting in the regional banking sector. I think intentionally they're probably targeting some of the venture capital investors that were responsible for the run on Silicon Valley Bank. My guess would be that that's where the target is, because that was highly coordinated online, and there's a ton of records of this bank run being created. So the SEC is taking the shorting seriously, but I think they're doing, and I'm surprised to hear these words coming out of my mouth, defending Gensler, but I think that he's making the right decision by vigorously prosecuting people that are abusing the short sale ability while not banning it and inviting more uncertainty.
I have nothing to add. I think you used all our time on that topic. No, it was clear JPMorgan and Jamie Dimon were responding to, the sort of resurgence in regional bank selling in the last couple of weeks. PacWest, Western, Zion's, others, after reporting some, crummy earnings.
I mean, they're also the bailout of last resort, it seems, or at least they have been this cycle. And, they were one of a few back in the great financial crisis that were sort of the depositors of last resort. So they have a vested interest in these regional banks holding up because they don't want to burden their balance sheet with a bunch of underperforming assets or illiquid assets. So they've got a vested interest in doing it. I think the SEC's approach to it has been appropriate.
Yep. Speaking of banking, that brings us to topic number 3, sort of a roundabout way towards banking. Cannabis industry has gotten some rare signs of life in the last couple of weeks, although stocks have pulled back a little bit in the last couple of days. A bipartisan committee in Congress is trying to revive the SAFE Banking Act, Secure and Fair Enforcement Banking Act, which essentially would provide banking services for the cannabis industry, which they haven't had heretofore. They tried this in, I think, December, in the lame duck period between the midterms and January, when everyone was sworn in, but that was sort of quashed by Mitch McConnell, among others. The meeting was yesterday. Cannabis stocks fell pretty sharply yesterday, even though, I was reading something, cannabis groups were pleased, apparently, with the discussion, but maybe investors weren't as much. I guess my question is this a good time to, buy cannabis stocks, which have been beaten down, 85% in the last 2 years? Or is this another fake out like in December?
For listeners, if you're interested in reading any of the documentation on this, banking.senate.gov/hearings, you can get the testimony, the prepared testimony, at least, from people that were at the hearing. I had 2 takeaways from it. One of the co-sponsors of this legislation, Steve Daines, Republican from Montana, came out explicitly and said that he's against federal legalization of marijuana. The sort of counter to that was he also recognized that things have changed significantly in this country with broadening state legalization, and it's sort of in an untenable position. The advocates for safe banking are saying that it's going to help social equity because it's going to open up to people of color banking services for their small businesses that they would not otherwise be able to access. People talk about safety for dispensary employees as being another driver because they're potentially an all cash business or a predominantly cash business. And then the third aspect is giving investors the opportunity to buy cannabis companies. One of the counterpoints to that is Dr. Kevin Sabet or Sabe, I don't know the pronunciation, with the Smart Approaches to Marijuana, who came out and basically said, what are we doing here? Why do we have this bill? There are plenty of companies that are willing to do banking or banking adjacent business with cannabis companies already. Why are we incentivizing big companies to invest billions or hundreds of billions of dollars in a product that essentially creates Big Tobacco 2 Electric Boogaloo, right? Like it's the sequel to Big Tobacco. It has the potential to become super widespread. So his talking points are sort of well taken. I think it's premature to use this as justification to invest in cannabis companies, but I do think that just based on pricing and valuation alone, it makes sense to be on the lookout for the companies that could be the consolidators in the industry. So those are going to be some of the bigger multi-state operators that are acquiring companies that are feeling the pinch of wholesale prices going down. And I think bottom fishing is probably the appropriate step. I don't think you can go whole hog and just invest whatever you would have invested into cannabis, right?
Yeah. No, I mean, we'll see. I think it's going to be tethered to the sort of the fate of this safe banking thing. So there's some optimism it'll happen before the end of the year, but we'll see. It doesn't seem like they made a whole lot of headway yesterday. So just maybe why the stocks fell, but any little thing could trigger a rally, but it's just a question of how long that rally actually lasts. It's sort of short-lived. But
yeah, anytime you're playing a guessing game with Washington, you're going to get burned.
Yeah.
Dollar cost average into your strongest cannabis stocks, maybe look for opportunistic buys if they come. Keep your ears open for federal movement, for federal action, because I think Curaleaf did a study and found that the majority of their stock price movement is attributable to news about legalization efforts. So that's the driver. And I mean, we're not big advocates for news-based investing.
Yeah. Okay, let's move on. Before we get to our guest, Bruce Kaser, just wanted to say, remind people that if you're listening to this, watching us on YouTube, listening on Apple Podcasts, or wherever you get your podcasts, please give us 5-star rating, hit the like button. If you're on YouTube, write a comment or review. Any of that stuff helps get this podcast sort of off the ground. This is our 4th episode, and audience has been good so far, but we still need to expand, keep expanding. That this keeps the lights on for us. So anything you could do, just take 60 seconds to do one of those things. It'd be much appreciated and very helpful.
Yeah, and thanks to anybody that was watching the show or listening to the show last week that took the time to do it. We appreciate it.
Yeah.
That's a great endorsement anytime you're able to do that or willing to do that. So we appreciate it. But Chris, definitely. I think probably time to bring on our guest.
Yeah, let's bring on. So Bruce Kaser is Cabot's value investing extraordinaire. He runs our 2 newsletters, his longtime Cabot turnaround letter, and then also the newly redubbed Cabot Value Investor. Bruce, welcome.
Great. Thanks to be a part of the show today.
Yeah, and one of the biggest reason we wanted to have you on today is you last week made your first pilgrimage to the Berkshire Hathaway annual shareholders meeting in Omaha. What were your takeaways? What did you think?
Yeah, Chris, it was really just a fascinating time. Again, it was my first time there. I went with my 16-year-old son, who was sort of interested in that kind of thing anyways. But it was really just fascinating. You can see this stuff online and watch it. But when you're there, you get a much better feel for who the people are, what the exhibits are, all the amazing breadth of companies and what they really mean. When you go get an ice cream bar at Dairy Queen and then walk across the way to the NetJets, Learjets, and then go over to see some industrial chemicals, and then some very impressive mobile homes. You get a sense of the spread of products that the companies have. There's really no company like that out there in the world. And so when you go there and actually see these products, touch and feel them, it just gives you a sense of what Warren Buffett's been able to assemble over the years. And it was real interesting too. The people were just very friendly, very kind, all very supportive of Warren Buffett and everything he's done. It was kind of, in a way, I got a sense that everybody knows that they're really a part of an amazing piece of history here, and they seem to sort of appreciate their role in that history. It was really quite an amazing thing that I think only being there in person can really bring out.
That's interesting that you mentioned being there in person, bringing out like that vibe and the energy and there's an aw shucks characteristic to Buffett and to sort of Berkshire that I think is maybe a little bit disingenuous or a little bit like facade-y. I think he's a shrewd businessman, and he sort of puts a sweater over that. Was there anything that you experienced in person that you could not have gotten from the recording, other than the sentiment and other than the public perception of it?
Yeah, I think there were many, and I guess two stand out. One is when I went to the Nebraska Furniture Mart. We read all about Nebraska Furniture Mart and how it was founded and all that kind of stuff, but you really don't get a feel. I really didn't get a feel for what it's really all about until you go there. And on paper, it kind of sounds like, gee, maybe it's like just another department store or some sort of trashy trinket store. But when you go there, you see the immense array of products, but you see things that are really useful. Like, for example, like with dishwashers, there are probably, I don't know, 100 different kinds of dishwashers and prices and models and everything. And who knows how to pick which one. They had a tremendous selection of really just well curated dishwashing machines. When you go to like a major retailer or one of these big box retailers, you might see them there, but a lot of them are all beaten up and look like they've fallen off a truck. And so you really don't know what these things are like when you actually buy one. When you go to Nebraska Furniture Mart, they're well maintained. They're like they're brand new, and you get a really good feel, a physical feel for the differences in quality and price and features and all that kind of stuff that you can't get anywhere else but by being side by side with a really good selection of high quality displays. And you get a sense also, I got that the people who help, they were very smart, very intelligent. These are not just sort of teenagers they dragged off the street, but these are really knowledgeable people who can answer your questions, and they have a little bit of a sense of humor, so you're not feeling like you're being pressed by pushy sales. You just that there and shine by going elsewhere, and I'm going to save money because I'm not buying the wrong thing or buying something else, and you just can't get that online or any other place.
And what was the biggest, if there's one, maybe there's multiple, I'm sure there are multiple, what the biggest actionable investment idea you learned that you might not have known before going in?
Well, I think in terms of a specific stock, just hearing Buffett talk about Apple and comparing it to really all the other companies that he owns. He used the example of people who would maybe not buy that, maybe they'd sell their second car or whatever. But they're not going to get rid of their iPhone. And some of the comments he made about how people are absolutely tied and committed to that Apple product, and that it's really like no other product in the world. You get a sense that maybe valuation for Apple isn't quite as important as it might be for other stocks. And as a value investor, I'm almost alarmed that those words coming out of their mouth. But
right,
that the franchise is there, the cash flow is there. Business just seemed to have tremendous value that I guess without going there and kind of hearing it in person, it doesn't really sink in quite so much. And then also, when you look at all the other companies that he owns, many have great features, but as an investment and as a business, but none of them quite have what Apple has in terms of very low capital intensity, very strong franchise among consumers, high margins. They're kind of a one of a kind, not so much a monopoly, but in a way, practically monopoly. You just don't see that anywhere else, even amongst pretty much all of his companies.
Yeah, you're right. I didn't have value extraordinaire Bruce Kaser pumping up pure growth stock Apple in my my podcast visit bingo card, but no, that's interesting to hear. Brad, you had a question?
Yeah, so when you were describing how Buffett sort of approached Apple and discussing Nebraska Furniture Mart, they both had a through line of uh, the heyday of business, right? Where products were made durably, high quality, for the right consumers, well-trained salespeople, stuff that we haven't seen in the last 40 years as everything has been just a race to the bottom. It's interesting that when you're talking about Apple like that, I'm getting that same sort of feeling about Nebraska Furniture Mart, and I mean that's refreshing. That's my only takeaway is it's refreshing to hear people say, oh, well, we're not going to race to the bottom on pricing. Margins will be good, but we're going to take care of our people and we're going to take care of our customers. And God, I'd love more companies to behave like that.
Yeah, that is a really good observation that there's a run line of sort of quality, good management that makes, makes sensible decisions about both how to get growth, but also how to make sure that business stays profitable. And the best way to do that is to take care of their customers. And I think for the most part, maybe a lot of companies have underestimated that consumers or businesses, they just want something that's reliable at a fair price that they can go to and not have to worry about it. And that's really, if there's a common theme, that's probably the common theme that you're right, you'd see through almost all of Buffett's companies.
How did Buffett and Charlie Munger seem at their elevated ages?
Yeah, well, our seats were way up, far
Right.
away.
Yeah.
Munger, he's in a wheelchair, so he's not very mobile. But
99, he said 99 years
he's
old.
99. Yeah.
Wow.
Mentally, he's just as sharp. He's sharper at 99 than probably everybody else is at half his age.
Right.
Just incredible wit and mental capacity. And Buffett, he might have been just a tad slow when he was going through some of the perfunctory comments about profits and losses and stuff. But when he was answering questions, he was spot on, totally on top of everything. So I think he just knows the business and is very much on top of it still. But they're in their 90s, and so physically they can't just jump up and down on stage. But mentally, just as sharp probably as ever.
And, looking at the bigger value picture, just beyond what you saw at the Berkshire Hathaway meeting, you've previously written recently that you've seen the macro environment as sort of a massive inventory cycle. Are you still seeing those signs in place right now?
Yeah, there still is quite a bit of that going on. You can see it specifically in the retail space. We had a massive inventory cycle across most retailers, not necessarily Macy's, which is a name we've been pretty bullish on in the turnaround letter. But for the most part, retailers overbought a lot of inventory about a year ago. Consumers decided to go do experiences and other stuff. And so a lot of the inventory sat on the shelves. That's being worked off now. So that's probably winding down. The semiconductor cycle, both chips and power and processing, that's still going through a pretty deep down cycle. Same kind of thing, overproduction and a slowdown in demand has led to a real glut in the channel and even at end customers. But that's starting to fade a little bit. We're not maybe at the bottom yet, but we're still seeing a pretty deep inventory cycle there and kind of through most of tech gear as well. With the auto industry, we had a inventory cycle there driven by shortages that seems to be working off quite a bit. Even things like Polaris, which makes snowmobiles and off-road vehicles, there is a sort of a negative inventory cycle there that's getting back to normal. So it's hard to put timelines on this, but I would say probably by the end of this calendar year, we should be pretty much through most of the inventory cycle, at least the the worst of it.
So you are a little bit cagey in your writing about what your stance is on macro. There's a lot of, I have loosely held opinions, but I'm looking at the numbers. Do you think that we can avoid a recession? I'm going to put you on the line a little bit.
Yeah, and I'm going to be equally cagey here. I really don't know. And I think recession is probably the most commonly bantered term, but there are many different kinds of recession.
Right.
A technical recession is negative GDP growth for 2 quarters. That could be down 0.01% for 2 quarters. That's, in terms of recession, the same kind of definition that you might have when the GDP is down 2, 3, 4, 8% over 2 quarters. So it's not so much a recession or not. I think it's how deep it is and what part of the economy it affects. Right now, it seems like the economy is fairly strong. The consumer seems to be slowing down a little bit. But on the industrial side, the industrial earnings have been, while weak, certainly a lot better than people expected. And in some cases, decent improvement from a year ago. So, I don't see any imminent signs of a collapse in either the industrial side or the consumer side. Government spending, which is a big part of the economy now, 20% or whatever, they're slowing down a little bit from a year ago, but there's still a lot of money flowing in from the government. So I just don't see any real, urgent panic here for recession. Some issues around the edges where maybe some banks will slow down in their lending. That might slow down the economy a little bit, but credit quality still is very high. So overall, it seems like the economy is doing, quite well here. So I don't, again, I'll be cagey, but I just really don't see any imminent downturn here.
Yeah, so it sounds like you're saying sort of acute localized pain throughout the economy, but rotating and leaving most of us relatively unscathed is sort of what I'm taking away from that.
Yeah, I think so. And recessions today are very different from what they were, 50 years ago when sort of all the economic history was being compiled. It used to be that, most of the economy would either grow or shrink kind of all at the same time. And it was driven by major cyclicals like cars and housing and stuff. But today there's so many different components of the economy. You can have a weakness in one area and a boom in another, and maybe growth in one and shrinkage in another. And so all that has to get boiled into one number. But I think your comment about rolling recessions by industry or whatever, that's probably what we're going to see now, and probably what we're going to see really going forward in the U.S. economy, unless we have a common downturn like a COVID downturn or a financial collapse where everything kind of shrinks from a macro perspective all at once.
Bruce, thanks for joining us today and for sharing your Berkshire Hathaway, your first Berkshire Hathaway experience. You thinking of going back, or is this going to be a one-time deal?
Well, it's hard to top, the first time. So
right. Yeah,
I might go back. Some people have been going for 20 consecutive years or more. So I'll let it sink in a little bit and make a decision a little bit down the road.
Yeah. Well, if you want to hear more from Bruce, and I highly recommend it, you can subscribe to either of his two or both newsletters. There's Cabot Value Investor, and there's Cabot Turnaround Letter. Both you can find both on the cabotwealth.com website under our premium advisories pull down. You've been running Turnaround Letter for a couple decades now. Is that right, Bruce?
It's been about 10 years. Absolutely.
10 years. Okay. Yeah. And Bruce's value picks have been beating the market for years. So I highly recommend both. Bruce, thanks again for joining us. Really appreciate it.
Great. Thank you.
Thanks, Bruce.
Thanks. Yeah. And thanks to everyone again for joining us this week. We'll be back next Friday. Again, if you like what you've heard, please throw us a 5-star rating,
smash that subscribe button.
Subscribe. Yeah, that's a big one.
It.
Yeah, smash it.
Like and subscribe. We're trying to become influencers here.
Yeah. Thankfully, Brad will be more well rested next week since the Suns won't be playing anymore.
Oh,
too soon?
Okay.
Too soon?
Yeah, I felt that one.
Okay, yeah. But for Brad Zimmerman, I'm Chris Preston, and we'll see you on next week's episode of Street Check.
Thanks for tuning in.